Hello everyone and welcome back to another video. Thank you so much for watching. Please do consider subscribing if you have not already. I do appreciate it and I see everyone that subscribes. So this is VMware and they were a spin-off asset of Dell. Dell used to own a majority, if not all, of VMware, and they recently spun them off into their own company. So what we're going to do is we're going to look at VMware stock, and this is September 16th, 2021, and VMware closed just under $140 in the markets today. Out of 11 analyst ratings, they are listed as a moderate buy at $176 price target. That's a 26% upside from where it is today. And the stock analysis, the SMART score is an 8. That's pretty good. You're not going to find much better than that. That's pretty good. We like that a lot. Let's get right into the income statement. So as we can see, over the last 6 years, VMware has had steadily growing revenues, which is what you want to see. It went from 6, 7, 8, 9, 10, 11. Literally, it's gone up about $1 billion a year. That's really what you want to see. Hopefully that compounds rapidly, as $1 billion a year is pretty good, but we can definitely do better than that. So that being said, they also had a very nice profit too of about $2 billion. Again, that's what you want to see. Slightly less than 20% profit margin. That's what you want to see. That's a really good sign of a good technology company in cybersecurity. So their cash has also grown to the highest it's been since 2018. That's what we want to see as well. We want to see high cash pile so that they can make some, decisions as far as, buying other companies, reinvesting, whatever they want to do with that. We just want to have flexibility and options. And their total current assets in 2021 is listed at 8.6 billion, with total current liabilities at about 8.3 billion. That's not great. They need to get better working capital than that. It could be a lot better, and we don't like to see that. They could definitely be doing a lot more, and that we just don't want to see that. We want to see better current assets. And total assets is about 29 billion versus about, let's just say, 20 billion for total liabilities. So they've got about a $9 billion headway there, and that's pretty good. That's what we want to see too. And we can also see that their total long-term debt has increased. We don't want to see that. That's not good. Again, they could do better working capital. They could, have lower long-term debt. That's actually one of the reasons why Dell spun off VMware, was to pay down some of their debt using that cash, and that helps. But VMware has their own debt, and we don't like that. We don't want to see that. As part of the cash flow statement, if we look, we can see, it starts out with their net income, and we can see that if we go down to acquisitions, they've been making a few acquisitions here and there. They made a $2.4 billion acquisition in 2020. No real divestitures, and if we look at their financing activities, we can see that they issued a ton of long-term debt, and they did pay back about 1.2 billion in 2021, the fiscal year, but that's not enough. They've issued way more lately than they've paid back. We just want to see that go down. Again, they have 4 billion in cash on hand. They could easily repay some of that debt, a little bit more than what they've been doing lately. And they've also been doing a few share buybacks. They did like a special, looks like $11 billion $11 billion dividend, special dividend probably. Probably something to do with Dell back in 2019. So you can go look that up. But either way, they have been doing some financing activities, and they've been, repurchasing some shares and paying down some debt. So if we were to look at a portfolio of VMware, they actually IPO'd in 2007, but because they went private, we can actually only see data from 2016, January 2016 to August 2021. So if you had invested $10,000 in that time, you would actually see a $31,000 end balance, which is good for a 22% compound annual growth rate, and that's what we want to see. If we look at annual returns since 2016, they didn't really have that great of a 2020, but you can see double digits, double digits from the previous 4 years previous to 2020, and that is what you want to see. That's pretty good. You're not going to get much better than that. And again, they had that special dividend back then. And the monthly returns in 2021 specifically, we can see that it really hasn't done much, to be honest. It's basically been stagnant, hasn't really gone anywhere, just kind of floundering around. So thank you guys for listening. I hope that you do enjoy this video, and please go watch my others. See you soon.